So today's Cardinal lesson, we're going to be using an example that we've used in a prior video, Tom and Chelsey, the 64-year-old couple that have substantial retirement assets, and they're going to be looking at Roth conversions and do they make sense for them, and then an actual proposal and laid out a multi-year plan for doing that. And so this is the second in a series of videos. You're going to see them coming up a lot, Tom and Chelsey in this example, as we cycle through all the things we do in financial planning for a typical couple. So I want to pass it to Tom. Tom's going to talk about why we're doing this video today.
Yeah, we're doing this video because taxes are important. The more you pay in taxes, the less you get to keep. And so what we want to do while we're doing this planning is how do we minimize your lifetime tax bill on this money specifically that you have not been taxed on yet? Traditional IRAs, traditional 401ks. How do we come up with a plan to draw that down systematically and pay the least amount of taxes possible? And so let me bring up the show notes. You can find these at the link below our video. They're also on our website. These are very, very similar to the ones last week. They might even be identical. We got the board, again, the same presentation with screenshots that we're going to go through in the software together. But before we do that, let me bring it back to Hans. He'll sort of position this, and then we'll get into the software and look at this case study.
Okay, so Tom and Chelsey, this may look familiar for those that have watched the video last week. They've got $750,000 in savings that they've already paid taxes on in a brokerage account. They have $2.5 million between both their IRAs. They have $230,000 in cash in a high interest savings account. And in their financial plan, they need to start out with a $12,000 a month monthly spend. And in the prior video, we showed them how to attain that, and with inflation on for the next 30 years, to keep increasing that $12,000 a month, and we showed them successful outcomes to get there. So we're not going to go over that again today. But in their current plan before they met us was to just retire, start Social Security so they'd have some money coming in, and then just supplement their spending out of this taxable money, so that they could go several years with paying little or no taxes, delay taking from the IRA till they had to, so they benefit from tax deferral, and pay as little tax as possible in the beginning, allowing their savings to grow. And that's fairly typical of people that really don't have a plan, but they've just penciled one out, and that's how they're going to operate, just kind of try out this retirement thing. When we get into the proposed plan, that in the last video we went over and we made some recommendations to guarantee that income or some level of the income in combination with Social Security. So what we're talking about today is this Roth conversion piece. And we're going to recommend Roth conversions. Tom's going to show you the software where he's doing all of that, up to the top of the 24% bracket, which for a couple is about $380,000 of income. So the difference between their income they already have and $380,000 is going to be the amount of the Roth conversion. And we're going to do that for several years. And then that's going to be the top of the 28% bracket when 2026 rolls around, when the tax rates revert back to what they were in 2017. So I'm going to not try to steal Tom's thunder, but in the recommendation that he's going to get into in the software is $250,000 to $300,000 a year of Roth conversions, and they're going to do, and then it's going to save them substantial taxes over their lifetime. So I want to push it to Tom, and he can just jump right in.
Yeah, and I would recommend, and Hans mentioned this, if you haven't seen the previous video, go watch that first, because it's going to give you a little more context of some of the stuff we're going to talk about today. So I'm not going to go through the same things we went on that last video, but I think it would be helpful to have seen that one before we go in here. But again, just real quickly, this is sort of a breakdown of their money, right? They have some savings, they have some different investments, IRA, taxable accounts. Again, the last video goes into more detail. I do want to flip over to the retirement tab, and this is where it runs through. I don't know that I mentioned it on the last video, but it's called a Monte Carlo simulation. You can Google that if you're not familiar with it. but it gives us a probability of success. Success meaning not running out of money. Failure is obviously when you run out of money. And again, these variables down here, the blue ones are the ones we have changed, and that's really the difference between the current plan and proposed plan. And so, like we did on the last video, we delayed Social Security to 70 for Tom. We have the annuities coming in that guarantees the income, one that gets them the income they need to delay Social Security, and then the one that has a lifetime income there. But then the other change we made is this tax proposal, and that's what today's video is on. You can see the current strategy versus this tax proposal, and that leads to part of this probability of success increasing. And so where we look at that is, let's sort of dig in a little bit of what we're looking here. It's under this tax tab, under tax strategies. And calibration is where I'm going to spend a little time, because I think this chart, it takes a little bit of sort of looking and studying to figure out what you're looking at here, but I think it's pretty insightful to see. This blue area, and so I'll just highlight that for a second, that is their taxable income, their projected taxable income on their current plan, which is take Social Security now, delay RMDs until, or delay taking money out of the IRA until 75 when RMDs start, and then just stick on that plan sort of for the rest of the time. And you'll notice that it has really low taxes in these early years, which is going to feel great, but then much higher taxes out here in the future. And so what we are proposing they do is sort of flip that. And that's what this green shaded area is let's go ahead and intentionally take money out of the IRA via Roth conversion specifically, pay taxes on it now, and be in a much lower tax bracket in the future. Some of the things that this is sort of people who like details here, estimated terminal tax rate of 30%. That assumes, like, if you both, in this example, both Tom and Chelsey pass away, they have 2 kids, and they leave this money to the traditional IRA money to their kids, what tax rate would they have to pay on that money? We're assuming 30%. That comes into play in some of the numbers in a second, and so I want to just point that out. And so we're assuming if there's still money left in traditional IRAs once they've both passed away, and the kids have to pay 30%, that just keep that in mind a little bit. The details tab, this is where it really starts laying out how much you can convert on a year-by-year basis. You might look at this number, 379, and know that that is awfully close to the top of that bracket, and they have some of the annuity income that we had factored in previously. The reason for that is when you're doing tax Roth conversions and you're trying to bump up to the top of that tax bracket, you get to take the standard deduction and to get to the taxable income. So your gross income will actually be higher than the 383 number that is currently the top of the 24% tax bracket, but then you get to take the standard deduction that puts you in a taxable income at that 24% rate. And then we sort of go on into the future, sort of year by year there. You'll notice in 2026, this number comes down pretty significantly. And if I go back to this chart, you'll notice that this rate, it shrinks. And that's what's happening there, is the sunsetting of the Tax Cut and Jobs Act. So currently in the law, when 2026 rolls around, our income tax rates are going to shrink, or the brackets are going to shrink, but the rates are going to increase. And so Hans had mentioned this, is not only is this now 28% tax bracket, it's also, you get there faster, right? It comes down and it's a higher percentage. And so especially if you're watching this and we're still in these years that we have these low tax rates, certainly you want to take advantage of this. But we have modeled the tax rate sunsetting. That's what the current law is. So that's what's happening in 2026. When we look at the details, that's why it's a lower amount in 2026 than it was in 2025. But you can see what's happening is we're taking money from this tax deferred account balance and we're shifting it over into the tax-free account over time. And again, there's a lot of assumptions here, and it's assuming growth rates and things like that. But what it's modeling is by about their late 70s, having everything converted to the Roth, and now they don't have any RMDs. They don't have to worry about taking money out. When I look at the summary, and so we're going to get back to some of the numbers that are on the board, and really, so okay, we do all this, but why are we doing this? Like, what benefit is this to us to do these Roth conversions? When I look at how much, and this is right here, how much less in taxes that Tom and Chelsey personally would pay over the rest of their lives, again, modeled to 95, they would pay 1.1, just over 1.1 million less in federal taxes. That actually might be state taxes too, but less taxes than they would otherwise have had to if they stuck to their original plan, which was not doing any Roth conversions. That is a significant amount of tax savings. Like that is a meaningful number that they are not having to pay in taxes. And so that does mean paying more taxes now in the early years than they otherwise would have had to. But long term, it's really beneficial. And we get this all the time is some people come in and say, hey, I came to talk to you guys about saving me in taxes, and you want me to pay how much in taxes this year? And it is, right? It's a little bit, it's sort of counterintuitive. I'm telling you to pay more taxes now to avoid future taxes. And some people just aren't willing to do it. But when we look at the life of this couple, modeled to 95, they save a lot less in taxes for them personally. But then the other question comes up, say, okay, I'm paying less in taxes. Yes, my income's covered by the annuities we've done, everything's like there. And so now I'm thinking about legacy estate planning. Are my kids, are they going to end up with more money by paying this? Because I got to pay a lot of taxes to get this money out. That's where that 30% terminal tax rate came into play. And that's what this number, they're pretty close in numbers here. But this, when you read it, it's 1.1 more of tax adjusted ending assets. So ending assets, both of them have died. They're passing on to their kids, assuming that IRA, traditional IRA money would be taxed at 30% and Roth money would not be taxed at all. How much better off are the kids by us doing this Roth conversion? It's a similar number, right? I mean, we paid 1.1 less in taxes and the kids are better off to almost exactly that same number. And so from a long-term standpoint, this is a great way to reduce your lifetime tax bill, even though that means paying more taxes now than you otherwise would have to.
Well, yeah, and you know, couples when they come to us, their biggest concern is like, how do I get money right now? All this financial plan that's kind of out there. We know it's our money. How do I get my money to live right now, and how much can I spend? And we talked about that in the last video. We just guaranteed that using about 40% of their money, maybe 45% of their money. We used to just purchase a guarantee of that income for life. So once people have that taken care of, and we show in the financial plan how they're effectively paying themselves what they need to spend, then the focus shifts to the first thing is what's going to happen to the survivor. Is the person, the one of us, we're assuming one of you is going to pass away before the other, and then the other one's going to live on. That's a big concern for people. So what's this going to look like? Well, from the income, with the annuities, the income's going to stay the same, but the taxes are dramatically different. And that's why we want to do those Roth conversions early, where we're enjoying filing a joint tax return and having the benefit of these rates. So there's a whole bunch involved in all of this. And we can, what Tom tried to show on the video, and he did show on the video, we do this with our clients, is they're sitting on the other side of a Zoom talking to us, and they're looking at their money on the screen, and Tom's there manipulating it. And for those that are software, computer friendly, they can actually go in there themselves in between meetings and mess with some of the variables, mess with the amounts of Roth conversions, and see the outcome. So this software is very useful when it's put on a Zoom screen, and then the clients are actually looking at their money, or you will be able to look at your money if you do a plan with us. So in any case, this is just the second of a series of videos. Most likely we're going to do 6. And first one was income. Second one was the Roth conversions. So we hit the income. We hit the IRA 401k. In all of this, we've delayed Social Security. We're going to talk later about long-term care. And we touched on estate planning in that the kids are going to pay less taxes on their inheritance. And of course, all of our videos are about taxes. So with that being said, I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.